Very good evening to everybody. I welcome all of you to the third edition of the Way2Wealth BFSI webinar series. The recent pandemic has accelerated the issue of delays and defaults in payments by customers to businesses. Renowned companies with decades of excellent track records are filing for bankruptcies. In this backdrop, we thought it would be appropriate to organize a session on credit insurance, which is an effective tool to protect a business from such contingencies. Some of the aspects which will be covered today include the need, structure, and benefits of this cover, as well as a few case studies. It's my pleasure to introduce today's speaker, Mr. Shantanu Pathak, Chief Investment Officer and Senior Vice President at Raheja QBE General Insurance Company. Raheja QBE is a specialist insurer which operates in segments where the Indian economy is poised to grow rapidly, and Shantanu is a member of the company's founding team. With a rich experience that spans over 18 years, his expertise lies in establishing new business segments, governance, and risk management practice. Shantanu's in-depth knowledge of trade credit and liability insurance helps clients to ring-fence from issues much beyond tangible assets. Shantanu is an MBA in Marketing and Finance and has a degree in law. He is also a fellow of the Insurance Institute of India. In love with nature, he is an avid cyclist in his leisure time. We have scheduled time for a Q&A session at the end of this presentation. Please feel free to post your queries via the chat window at any time during the webinar, and we will respond to as many as possible. We look forward to a very engaging presentation. Over to you, Mr. Pathak.
Thanks a lot. Kaushal, you can make it probably full screen, the slide. So I guess you all can see the slide which is in front of you, which says about trade credit insurance. So we'll just quickly see in next 50-55 minutes as to what it is about. So we can move on to the next slide. And one thing which I would say in front of you where we are, which is 2020, and we all are talking about the pandemic around us and how it is shaping our lives and businesses. And if I don't get into the personal side of business, because we are here for a particular subject matter, which is trade credit. So financially, when we had seen 2008 happening and all that recession thing, which was all around us, everybody started talking what happened during the Great Depression of 1930 and similar stuff. And we thought that 2008 is something which is so bad, such collapse of banking system which has happened, we would have learned a lesson and nothing wrong can ever happen back to us, at least in a very short span point in time. But if you look at today, which is probably around 10-12 years, we are talking from 2008, again, we are in a very bad situation. And completely different reasons are the reasons which are now in front of us. So the only thing which I'm trying to say is that when we see a bad timing in terms of financial systems, financial ecosystem, from where it will originate and what kind of span it may really go up to is anybody's guess. The reasons which can make it happen is something, despite best of our efforts, best of our risk management practices, is something can always baffle us. So I would say 2020 is something like that. It's nothing which started because of economic reason. It's something started for an altogether different reason and has cascaded in such a manner that our economic lives are in tough situation at this point in time. So now what do we learn out of it and what do we see? So let's have a next slide. So when I say these 2 years, when I said 2020 and 2020, what is the difference? I would say one thing from the business perspective which has changed in Indian scenario is the Insolvency and Bankruptcy Code which has come. I understand from the audience perspective that most of you must be from the side of finance in your background or accounts or banking or commercial aspect of it. So what we have been reading in the media about Insolvency and Bankruptcy Code for last 3 to 4 years is something which I'm very, very optimistic about. Obviously, it's maybe a few early years. We'll have a time when these things will develop much better. But I strongly believe this is what will make a lot of difference to our country. When we say Atmanirbhar Bharat, when we say that make in India, or when we say that making our name in international markets, we have to realize something about the financial discipline in the entire system which we are talking. People should not be able to make use of system the way they want, make wrong money out of it or wrong practices come into the play, and then come back again. At the end of the day, it's taxpayers' money which goes into all of this, and that stalls companies and economies and countries' growth, and which is not the right thing. So I very strongly believe this kind of code, obviously we have seen as of now this code not as a complete result which has come into the market, and that will take. But still we have seen a lot of things happening as well. So it's not that it's not there. So that is where I would come from and feel that these things can become great. So we can now move on to the next slide. I see a line coming in between. I don't know for what reason. Right. So we can make it full screen now. So now what are we going to talk specifically in today's session is that what are the basics of trade credit insurance? Some of you may know of it, some of you may be absolutely new. So we'll cover all those aspects in the question and answer session. I guess one difference between when you talk in a webinar and face-to-face is that probably you always put question and ask a little later, and some people may feel like that it's not as lively. So I would say you can always put your questions in chat box and we'll look at it later. Then after trade credit basics, we'll just go through and see what is not covered by this policy. When someone has not paid your money, policy has to be triggered. How does the collection mechanism works? What are the collection action? What is exactly evidence of debt for claims lodgement, which is at the very core of this particular business. And everybody should understand when they buy a trade credit insurance policy, how evidence of debt is important from the legal perspective, from the policy perspective. And then we will, after having understood all of this, should try to understand that how a trade credit policy can really help businesses on the ground. So when you have your own business, which may be a service business, which may be a manufacturing business, which may be a trading business, how does it fit into your kind of business exposures when you deal in your business wherein you're giving someone a credit line and then you don't want anything to go wrong there. And then we'll see some of the case studies in market with experience as to how the claims have happened, how underwriting elements have been there in those scenarios, and practicality of this particular business proposition of insurance cover. Can move on to the next slide. Right. So firstly, let's talk about what are trade credit basics. So when we say trade credit basics, so there are few slides in which we'll be talking about. We can move on to the next slide. So in trade credit basics, what typically happens in any business, you sell your goods on credit terms to the other business, because that's how we have seen the market is. Market is no longer working on a cash basis, which would have been a concept of some part in the last century, probably I would say. And again, in last century, not the whole part of it, some part. So today when we are talking about it, so what typically happens when you sell your goods on credit? There is always a risk of payment not being made. The moment I have done a credit sales, a risk is created. What is the probability of that risk? Yes, it's a judgment we can always make. This is our past relationship, this is the amount involved, this is the tenure involved, and so many parameters which may be there. But the very fundamental fact doesn't change. The moment I have sold my goods to a party and I will be collecting my money only at a later date, that risk of payment has been created. It's something like this, that when you give a credit, it's my money which is sitting in someone else's balance sheet. So accounts receivable is something I put it like that, because I have already sold my goods, which means it's gone out of my books. That expense has been created, that cost has been created, that effort has been created, but the money is not there. So which means it's my cash, it's my money, which is sitting in someone else's balance sheet. And that is something most of the accounts people are never comfortable with. So how do we deal with it? Yeah, please move on to the next slide. So what typically happens in a trade scenario, terms of payment, extension period are the common things which we talk when we talk this particular insurance policy. So what we say is, let's say in the month of April or any particular month, you have made your shipments. And once you have done your shipments, what you say is that, okay, today I have done it. Goods are going to you. You will be getting it in whatever specific time we have discussed and agreed upon. And from that date, I have raised my invoice or whatever terms of payment we have agreed and discussed upon. There's a due date, which means on 60th day, you have to make the payment. And what typically happens is that by that logic, if it has gone in the month of April 1 date, then by May end, I should get my money because that is the due date. But in the practicality of life, for X, Y, Z reasons, we see that sometimes my buyer may not pay me by that particular date. And my buyer may say that, see, I have some problem, which I am discussing with you with open heart, that this is the problem I'm facing. Give me another week's time, give me another 10 days time when I'll be making the payment. So when you hear your buyer with whom you have been dealing with number of years, you're convinced of the reasoning why he's saying so, or typically it comes to your mind, fine, it's okay, I can help him out. I'm okay to grant him another 7 days. I'm okay to grant him another 10 days. And you give him that extension. But then there is another buyer with whom you may not have dealt in past. You're dealing that buyer for the very first time in your life. And then he says that I am not in a position to pay. At that point in time, your mind is never going to be at ease, because you are dealing with this buyer for the first time. And in the very first consignment, he says that, see, I am not in a position to pay up. While due date has come, I'll come back to you only after 30 days. But that causes you to have some jitters. So you take a call whether I give that extension to this particular buyer or not. If I do not give him extension, what can happen? He'll be unhappy with me. He may not do next business with me. He may pay me this money because of the pressure tactics I may advise or not. But certainly my special relationship which I was looking at developing will never come up. So that is where a business takes a call to give an extension or not give an extension. And that is what is something called maximum extension period under the policy. There's no fixed rule that what you have to do and what you don't have to do. At the end of the day, it is business's call whether to grant that extension to the buyer or not. If the business feel like they should go ahead. And the policy doesn't come into play, underwriters doesn't come into play. We do not talk to the clients at that stage. That's a call as a policyholder you can take. But yes, this timeline as an extension period is very clearly defined in the policy, and it runs accordingly. And say in this example, what we are talking, that extension is 60 days. So the June is over, July is over. So the money which was out of the sale on 1st of April has now become 4 months due. Overdue for 60 days. That's how the scenario is. What happens afterwards? Should you continue dealing with that buyer? Because he has not paid you in the first 60 days when he ought to have made the payment in the routine course. But even then extension duration is over and the buyer has still not paid up. Same story, same points which I said earlier. You may have been dealing with that buyer in past, but now what? Should you continue dealing with them buyer? Should you stop or not? Again, that's a business call. Policy cannot come into play. Policy cannot say that you should stop dealing with them or not. But having said that, the fact remains, insurance policy will stop covering any future shipments beyond this maximum extension period. Because now, if you really look at, a time has come wherein not just the original payment has come, during extension period, whatever has happened is also come into play, and there's no light at the end of the tunnel, as we say. Maybe a profound sentence to say no light at the end of the tunnel, because the client may still pay up. But the fact remains, it's too much of an elongated duration to really continue giving a cover out of it. So insurance policies after this extension period says, the way structured is that after this, if there is any other shipment done, that is on account of the business, and the insurance policy will not take care of that particular part. Anything prior to that is completely part of the cover. So we can move on to the next slide, please. Now, what are the types of cover? So when we say types of cover, there are basically two types of broad structure, and obviously I'm restricting myself largely to Indian context. So we have a domestic cover and we have an export cover. So in a domestic cover, obviously your buyer is based out of your country only, and you are giving them sales services within the geography of India, within the legal system of India, and you are doing it. So what is covered in domestic policy? In the domestic policy, there are two covers. First cover, insolvency of the buyer. Second cover, protected default. What is insolvency of a buyer? Obviously, we'll see these things a little bit more in detail in next few slides. But in general, we all understand the buyer has simply legally raised his hands up. I'm done. I'm out. My business has got no money and I cannot pay up. I'm going out of business. So that's insolvency. And now when we are talking the new code, the new insolvency code, which has come in our country, we expect these things to be very, very good, very, very smooth going forward. We have seen some of the examples in international markets wherein the kind of insolvency procedure they have, you can see the entire process is getting, I'm not saying all the cases, but a lot of cases getting settled within as good as 6 months time frame. So when we talk of US scenario wherein Chapter 11 is something which is commonly discussed about in this context, provides those kind of speedy settlements as well. What is protected default? Now, protected default is something which we always and very often see in our day-to-day business scenario, and that is where the crux of day-to-day pain also comes into play. A protected default is something wherein a buyer is just not paying up. Now, why is he not paying up? He doesn't have money because when he on-sold his goods, he did not receive from his end buyers. So what has happened? He doesn't have the money. So the cycle of the business, because we all understand now the kind of chain we all work with, the chain reaction happens, and that ripple effect comes on to your business because his onward sales realization, his accounts receivables are also stuck. Pure, simple business linkage problem wherein we understand that how all the businesses today are interlinked with each other. One reason. Second reason, he made a big bet in one particular large order and that order got stuck and he has invested a lot of money. He has put in money out of the earning of this particular business into a new business segment wherein he was not at all ever before. So rather than taking large loans or small loans or whatever other financing arrangement, he did play on the credit part as well, that okay, I have this much of credit play with me available, and why not get into the new business line? By the time my credit will become due, I should be able to generate cash. But those cycles fail, do not come up to his expectations, and he's in a bad shape. Betting, how does that look like? Don't we all at one point in time, right way or the wrong way, bet on something or the other? So I'm talking the wrong parts of business also. I'm not saying stock market is betting, or I'm not saying sports is a betting. But yes, sometimes it does happen that people invest money in completely bizarre things, which doesn't come to our mind as the regular standard logical decisions, but they may have taken that decision. So my buyer, what he may have done is he may have put that money in stock market, he may have put that money in real estate, thinking that he can generate great alpha, generate great returns out of those investments. But the cycle turns, those businesses, those industries may not work the way he anticipated, and again he's cash strapped. But this has got nothing, absolutely nothing to do with his day-to-day business with which you are dealing. But the result is your business is getting impacted out of it. So when we say protected default, in the reality of life, if you look at protected default is something that your buyer is simply not paying you. Why? Could be any reason. You cannot really pen down that, okay, I'm listing down these 5 reasons why he's not paying up. The fact is he's just not paying up because he doesn't have money to pay. That's it, plain simple. As good as that, that's his way of dealing business. That's his way that whatever terms I do, I don't honor them and then try to stretch them to a certain duration. Some businesses have a bad name that while on paper they may give you a credit time frame, but in reality, they will always run 1x or 1.5x or 2x of it. And people still deal with them because they have been there in the market for long. As simple as that. So what's happening again? Your cash sitting in your buyer's balance sheet. Another cover which happens is about exports. So what happens in case of exports? Yes, insolvency of the buyer is covered. Protected default by the buyer is covered. But on top of it, there is another larger risks which is associated to export, is also covered in an export trade credit insurance policy. And that is about political risks. And how these political and economic factors can play is that you may have a situation wherein you may deal with currency inconvertibility. Now, why can a currency inconvertibility may happen? Because of the economic situations, because of the sanctions, and so on and so forth. There may be export and import restrictions, and the government may not allow your buyer to pay you the money. So there may be nothing and absolutely nothing wrong with your buyer. He may be okay to pay your money. He's in perfect sound condition, but these situations are not allowing him to pay you the money. And that's where you get stuck. So he's not actually insolvent. He's not in a protected default zone, but he's constrained because of these factors, which is beyond anybody's control because of the economic and political situations in those countries. So this is how the two types of covers operate. We can move on to the next slide. Buyer limits. Now, what is buyer limits and who's a buyer? A buyer is at the core of trade credit insurance policy, isn't it? So I'm dealing with 100 buyers, I'm dealing with 20 buyers, I'm dealing with 5,000 buyers. Depending on the nature of business I'm into, depending on the scale of my business, that's how my buyer set looks like. So what trade credit does is, it says that in your policy, you have a particular level of deductible, which will not be covered in the policy. So any buyer with whom your exposure is not going to cross that deductible level will have no sense to be part of the policy, and things work like that. Most of the businesses operate on a 80-20 business. So what happens in an 80-20 business is that, yes, there are top 20 buyers who give me 80% of my revenue. My dependence on these top set of buyers is very, very high. And the balance 80 buyers on my book are the ones there. I cannot ignore them. But yes, if one of them goes out, if two of them goes out, there will be some impact on my business, but they will not be a great impact. I can handle them on my own. So what an insurance policy can do is, insurance policy can design a discretionary limit. As an example, say 100 is the level of discretionary limit. You have a buyer set wherein you feel that, okay, with this kind of a buyer set, I will never cross 10 lakh rupees of exposure or 20 lakh rupees of exposure or whatever. So you agree with your insurance company, with your underwriter, to put that as a discretionary limit. And up till that discretionary limit, you need not take a buyer limit. Any buyer with whom you are dealing is automatically part of the insurance policy. Yes, there are precautions which insurance policy will put into place. They will ask what kind of credit management system do you have? How do you approve limits to your buyer? What kind of know your customer guidelines you do? How many years have you been dealing with them? Do they have a banking line for which you have taken a proof and you know that yes, they are indeed credit worthy? So to that particular smaller level as well. And then comes the next level, which is about wherein you go to the insurance company and each and every insurance buyer is given an individual limit. In Indian context, when I'm talking about the regulations, the way we have our system is also require mandatorily for any buyer contributing more than 2% to the sales turnover of the business to have a limit from the insurance company. So any buyer who's individually contributing less than that level only can actually be put into the discretionary limit system. But any buyer above 2% contribution to the business has to mandatorily to be given a limit by the insurance policy. He has to be assessed for his financial credit limit and accordingly go into the policy. So with one particular buyer, if you look at the spikes in front of you, few spikes says that they are exactly touching the buyer exposure you have. In some cases it is lesser and some cases it is higher. So what it typically means? It typically means on a particular buyer, I'm dealing on a basis of 1 crore rupees of credit limit. On another buyer, I may be dealing on a credit limit basis of 5 crore, another buyer 50 lakh or whatever be the figure. Insurance company will assess that individual buyer, see what kind of balance sheet he has, is he profitable, what kind of business expansion he has, what kind of parental background he has. If it is a subsidiary company to a large corporate conglomerate, is there a backing from the parent, or is it not? Is it a joint venture nature? Is it only an investment nature? How's their buyer segment in general? Because when he buys something from you, obviously, how's his market? Is his market going to sustain very strongly in the coming years? I may be a simply, say for an example, I may be only manufacturing ink, and I'm supplying my ink to an FMCG company because in their packaging they need my ink. But to that FMCG company, who are their buyers? Are they dealing in B2B? Are they dealing in B2C? Are they going to have any pressure? So while my business of ink doesn't have a pressure as such, but is their business going to be under any pressure if they are into real estate business, if they are into whatever industry? It's just an example. It's not about real estate as a business as such. I'm only saying as an example that in a particular business, what kind of cycle, what kind of market scenario are they into it? And basis all those factors, you get a buyer limit. So once you get a buyer limit, this is the level in your insurance policy you are covered for. So any buyer, whatever limit has been assigned in the policy is the limit. Yes, this limit can be revised. Insurance company, if you have going to get a higher exposure over a period of time, you can ask, insurance company can come back that, okay, even a higher limit can be given to this particular buyer. But at the same time, insurance companies do regular assessment of buyers on a continuous monitoring basis. If they realize that a particular buyer is getting into difficult time zone, then they may come back to you, say that this buyer no longer can afford to have this kind of a limit. So we are going to suggest you to have a lower limit on this particular buyer. So that also happens. So this is something which I would say is at the core of this particular policy. Now we move on to the next slide, please. Insolvency. We discussed insolvency, so I'll not take much time on this slide. But yes, this is about official legal insolvency. What should happen is that the moment insolvency has happened in any of your buyer set, wherever you are dealing, please let your insurance company know this has happened. Get the evidence of debt confirmation from the official liquidator so that you know that you are there in the list of stakeholders and your name is registered properly, promptly with the amounts involved, and see how do you go about it. Once the evidence of debt confirmation of insolvency proceeding is shared, this policy then in next 30 days, most of the policies you will find out are designed in the market in such a manner that the claim is made within 30 days. And the recovery, whatever can be done from the estate of that particular insolvent company is what continues by the insurance companies. You can move on to the next slide, please. Okay, so this is a bit complex and looking a slide a bit lengthy. So let's understand what the protected default timelines are. Like in the previous slide, when I was talking of insolvency, I said we get a proof of insolvency. We prove that our name is there, evidence of debt, and within 30 days claims are paid for. But in case of protected default, it works a little different. It's a little long drawn process as to how this goes. So here, suppose we have made an invoice. If you look at the slide in front of you, what says is that on the first block says about invoice date is 1st of June 2020. And the terms of payment are 60 days, which means by 30th July, you should get your money. That is the normal due date. After the normal due date, we did discuss about maximum extension period, which the policy can have. As a policy owner, you may take a call whether to use that extension period or not. So you decide, you use those 30 days, you use 15 days, you don't use it. If you don't use it, from that moment onwards, the protracted default period starts. I'll talk about what the protected default period means. But yes, it can start immediately if you choose not to go for the extension to that particular buyer. But suppose you have chosen that and that extension period of 30 days is also over. Now what do you do? Now your MEP period is expired, extension period is expired, and debt is actually overdue even in the insurance policy's terminology. Yes, it was overdue after the 60 days, but because of this concept of extension period, insurance policy will start calling it overdue from this particular date when extension period is also over, or if the insured has chosen not to use the extension period from that date. And most of the policies, if you look at us, got 180 days protected default period. Some policies may have slightly lesser, but largely, by and large, in our market, you will find it, even in international market, you will find the range is around 180 days. Now, what happens in this period and why this period is so long? What happens in this period and why this period is so long is principally because at the end of the day, we all have realized that most of the time when my money doesn't come from my buyer, barring a few exceptions when the guy is probably just not looking at paying me up and I have 100% confidence otherwise that he can't pay me up, we want to salvage the situation. Every business look at really salvaging the situation without spoiling the relationship with that particular buyer. We feel that, okay, if we can have a renegotiation, if we can give him some discount, or we cajole him in some manner and see that, okay, with all these options, can you pay my money? Can we agree on a repayment terms that, okay, instead of paying me in one shot, okay, can you pay me in 3 installments or 4 installments, or whatever mechanisms you look at. So this is a duration when what typically happens is a policyholder, a business tries to make all the collections possible recoveries. How is it done? You have collection agencies in the market. If you feel that given the gravity of the situation, it doesn't make sense for you to go on your own, you can consult your insurance company. Insurance company can help you in appointing a collection agency, which is obviously comprising a team of lawyers who will go and nudge your buyer that, see, this is where we stand. Please pay up. If you don't pay up, this is though the first step, we can then go into the full level of recovery, the legal mechanism, which can come at a very heavy cost to you. So why don't you agree for some other kind of a payment? So all these activities happen during this duration of 180 days, wherein the policyholders keep on consulting with insurance company. Depending on the nature of policy construct, you may give the job to insurance company in totality. You may not want to give the job to insurance company in totality, may want to work in collaboration, or the insured business may want to be always on the front because they don't want to spoil their relationship with the client, and on the back have a consultancy from the insurance partner. But even after this duration, once this protected default period is over, you have not got your complete money. The business is not able to get all of it. You may have got 50% recovery, you may have got 10%, and you may have got nothing. So whatever you have not received is become a valid legally liable claim, and then that claim is paid within next 30 days after that duration. While you are doing all these activities, if you really look at in this elongated duration, you get to know all facts and figures of the claim. So making a claim file doesn't take very lengthy afterwards because it's already all in that duration which has happened. So within the promised time frame, which most of the insurance policies actually give as a written timeline in their structures, the claim is paid for. We can now move on to the next slide, please. Political risk. Now, in political risk, as we said, that why it can happen is that because there may be a public sector company which may have defaulted, there may be a currency inconvertibility, and things like that, civil unrest and such structures which we did. So in case of these kind of situations, because of political risk in your export consignments, wherein this policy is triggered, what typically happens is, again, there are timeframes given to particular countries because there is a great weightage attached to the individual country rating. It's not so much about your buyer, it is so much about that particular country's rating, and basis that there are timeframes, and within those timeframes, if some things can be weighted out and got a solution to it, is done. Otherwise, the claim payments are made. And obviously, like usual business, once you have made a claim payment, the recoveries continue, because having made the claim payment is one thing, doesn't mean the buyer is absolved of his responsibility or liability. He has not made the money, so rest he is responsible to pay it. So insurance companies, after making the payment, go via the subrogation route and make the efforts to collect that particular money. Please, next slide, please. Yeah, what is not covered? Now, I guess, say, when we buy insurance, a lot of time insurance doesn't get a very good name, in the sense that in the event of a claim, I was told that this is not covered. And when I bought it, on the day when I was told everything is covered. So as an insurance personnel, I would like to make a statement here that whenever you buy an insurance policy, please be extra cautious in terms of asking questions. Ask as many questions as you want, because understand, insurance at the end of the day is also a business. Insurance at the end of the day is also a financial arrangement. So it's never true that everything is covered. There are things which are not covered. There are reasons why they are not covered. And you should upfront understand the scope of coverage which your policy has and what is not within the scope of coverage and beyond that. Sometimes some things which are not covered may be covered at a particular price, may be covered with particular terms and conditions, may be covered in some different manner, but not as a standalone, not as a standard cover. And you can then go about it taking care of your business's specific requirement. So what is not covered? So let's look at some of the things which are not covered in the next slide. Now, one thing, obviously, we talk about the buyer limits. So whatever is beyond buyer limit, which has been granted in the policy, is not covered. This is essentially a B2B product. So if you are making a sale to a private individual, that is not covered. Any sale to an associated company is not covered, because you have to always see that there cannot be a conflict of interest. So if there is a sister company and you're dealing with that sister company, those kind of transactions cannot be covered. Government departments and sales to government, which are in domestic sales, in Indian context I'm talking about, is not coverable, because the way current regulations from the IRDA perspective are, they do not allow coverage of such sales. Anything which is on bank guarantee, anything which is on letter of credit is also not covered. Why not covered? Because it's not an open sales. It's a sale which is secured sale, so it is not covered. Having said that, we have come across cases wherein people say that in a particular geography, in a particular country, the kind of bank I'm dealing with, my confidence level is not 100%, it is slightly lesser. So I want a cover despite this being an LC sales. So in such cases, a cover is granted even on LC sales. And there what typically happens is, instead of buyer, the coverage is on that particular bank which the insurance companies provide for. Another thing which is not covered is the amount, which is 85%. So again, because of the out of the indemnity, which I am talking at this point in time in our market. So in Indian market, 85% is the indemnity level. So out of the invoice value of 100, 85% is what the insurance policy pay, and 15% of the risk is on account of policyholder. Now, one thing which I would like to talk at length, or maybe more about what is not covered, is actually about disputes. The rest of the things which are not covered are pretty simple, I would put it like that. But let us all understand very clearly one thing, that a dispute is never covered in a trade credit policy, because this policy is to cover accounts receivable. An account which is legally enforceable. When is an account receivable? When it is a legally enforceable debt. And when it is called a legally enforceable debt is only a scenario when it is not disputed as a sale in the very first place. Because if you go to a court of law and say that so-and-so has not paid my money and I want money because I've supplied him goods, I've provided him the services as per our contractual terms, whatever considerations and other parameters whether have been met, but my money has not come. A legal system, a court of law will always talk about why your money has not come. And that why has always to be answered, and accordingly you can get into that system and get an answer out of this particular scenario. So what that particular system says is always about legally enforceable debt. Gentlemen and ladies, just give me a pause of 2, 3, 5 seconds. I realize that my computer is going off the battery, so let me plug it in. Just a second. Seconds. Yeah, so coming back. So coming back to disputes. So what happens in case of a dispute is that I made my sale and my buyer says that the goods are not as per the specifications we have agreed for. And the goods are not as per the specification we have agreed for, it will not fly. There's an element of claim. You feel it is, they feel it is not. What do? We go to a lab, get it tested, do other consultancy mechanisms and come to a conclusion. But an insurance policy and insurance company is never a juridical authority which can say that this is right or not. So a disputed sale resulting in non-payment of money cannot be covered. Yes, that doesn't mean the claim is not payable. Only thing is claim is temporarily suspended. Once you are in a position to get out of this situation legally or otherwise, and if still the money is not coming through, insurance policy will pick it up without any issue. It will be back to the routine business. And if it still falls into the definition of money not coming through as an account receivable, policy will pick it up. But otherwise, a disputed sale is not covered. So one needs to ensure that buyers do not make frivolous issues out of dispute scenarios. Please move on to the next slide. Next slide, collection action. Yeah, we can go to the next slide. Now, collection action. What is collection action? Now, collection action is something, as I was talking to you when I was talking about protected default. Whenever there is a notifiable event happen, which means the buyer has not paid the money even after the due dates, let the insurance company know. We can together talk about how do we go about it. There can be a debt collector. There are lawyers available in the market who these kind of jobs. You can do phone follow-ups, you can do demands issued, you can do site visits. If you have issued checks which have bounced, you can give a threat, or you can cajole the buyer that, see, 130 had got so and so provisions. Basis that you will be in trouble if you don't pay up, and I'll take those issues. You can commence other legal action. Doesn't mean that you have to conclude legal action, and legal action cannot be concluded very collectively or very quickly. But legal actions can always put you in a situation wherein you can very quickly make a case, so that later on you can tell your buyer that I did everything which was available to your insurance company and buyer both, but still the money has not come. Make repayment plans, offer of resettlement, and despite that, if the debt is still uncollectible, it is a claim. Let's move on to the next slide, please. Now, I spoke a lot about evidence of debt in a claims lodgement. What does evidence of debt means? Please move on to the next slide. And always remember, evidence of debt is at the core of this particular policy. So what we always suggest is, don't give your buyer a chance, an excuse to make a frivolous reason that why the money has not come in, or raise a frivolous dispute as such. So what we typically say is that whenever you're doing such things, always get a confirmation of debt from your buyers. When you're selling, say that you have received the goods in good condition. If you're not raising it within the stipulated time of a week or 10 days or 15, whatever is your trade practices, then goods are considered. If you can get a proactive, formal confirmation, nothing like that. If you don't get a direct confirmation, at least get an indirect confirmation that if I'm not notified by such and such date, it is deemed to be a receipt of goods in your custody in good sense. Confirmation of debt from the insolvency practitioner we discussed in our previous slides, that always ensure that you, with your due name and with your due amounts and with your dues, is properly put in there. Always look for written acknowledgements, because if you don't get written acknowledgements, then it becomes very difficult to go next step a lot of time. Try to put in a deed of settlement. Have your invoices, proof of shipment, bill of lading, statement of accounts, always ready. Don't just send a simple invoice and forget it. If you have got multiple invoices, use statement of accounts, say that this is what has happened, so that the buyer should never have a reason to say that I was never told, I never knew, my warehouse, I have 50 warehouses, I never know that what happened in the warehouse number 25th, you never told me. So always on a periodic basis, try to do all these kind of activities. In case of political risks, wherever you have such situation of, we spoke in case of export, which is about currency inconvertibility, you may have moratoriums and you may have cancellation of licenses. So have evidence and proofs of these things. A lot of such things may actually be available even in public domain. But if not in public domain, there are departments who issue these things from the government side. Have those things collected so that you can have a speedy discussion with your insurance company. Yeah, please move on to the next slide. So now in my agenda, I said that how trade credit insurance help. We said trade credit insurance essentially help in three ways. And there are next slides, I'll talk about 4 buckets about these 3 points elaborating is that this is about risk management. This is about claims benefit. Obviously, anything about insurance is about claims benefit. But beyond claims benefit, it is about risk management and risk assessment and monitoring. How does that work? Let's look at in the next slide. Please move on to the next slide. How we look at it is, we can move on to the further next slide. What typically happens is, I'm dealing with a particular buyer for last good number of years. I may be dealing with a particular buyer for say 15 years or 20 years, or maybe for generations together. So my confidence level on that buyer is bound to be very good. But practically what happens when things go bad, that particular buyer is facing problem in his business. He may start defaulting in the market, and he may not default with you. He may have defaulted at one particular place. He may not have defaulted with you because your amount was smaller, or maybe he wants to protect your relationship because he really feel you are a great relationship, so he has not defaulted to you. But the point which remains and just cannot go away is that he is in financial distress. So if not today, tomorrow the impact of his default will come onto your business as well. So if that impact is going to come onto my business also, what should I do? The moment I get an early sign, which is where this kind of policy comes into place, because insurance policies, insurance companies, when they monitor buyers, they keep on monitoring them on a global basis, at subsidiary level, at parent level, at associate companies level. And basis all those elements, if the profitability is declining quarter by quarter, year by year, half yearly by half yearly, they keep on noticing those parameters. Are litigations increasing compared to previous litigations? What are the nature of new litigations which have come in? These are the early signs and early triggers which come. And this is where knowledge of the customer comes. So this is where the essential risk assessment comes. You may be going to a buyer, but the buyer is in an industry you have never dealt in past. Your product is your product, which may be used in 10 different kind of industries. You may have been dealing with half of those industries, but another half of industries wherein you are not dealing, you are entering new. What are their trade practices in that particular country, in that particular geography, is what you get to know. And all this monitoring for the formal customer review and these information sharing, obviously always on a confidentiality basis, is a regular business practice. So insurance companies give you a much better example. I'm not saying that an insurance policy will have a crystal ball and they will know that which buyer is going to default and which buyer is not going to default. But the early trigger sign can always help us. And that's where the crux of this policy comes into play. So it is not just about claims management. It is not just about paying the claims. It is also about using that vast database knowledge of the buyers, which are being monitored on a regular basis through multiple sources. It's not just the financial statements of that particular buyer is looked at. It's looked at what kind of new businesses they are entering into. It's looked at what kind of new geographies are into, what kind of litigation are they getting into. So many parameters are looked at. For smaller buyers, if the company is say a proprietorship firm or the buyer is just a partnership firm and is a small business, physical visits are made to their premises to look at. Personal interviews are conducted with the buyer set to know more about their businesses. It goes to those nitty-gritty levels as well. So it's not just that a public domain information is analyzed on the numbers basis, because numbers can lie a lot and we cannot rely only on numbers all that time. So it is not as straightforward that I've just looked at a financial statement and come out with a limit. It goes much, much beyond. And then what we discussed in last almost 50 minutes, 45 minutes at length about the risk management, which comes about how debt collection, legal pursuit, and negotiations can be done in collaboration with the insurance company is essential benefit of this policy. And last but not least is the claim payment, because once a claim payment comes through, we all realize that if a sales goes wrong, we do not lose profit. If we have a profit margin of 10%, then actually by a claim money not coming through and that debt money not coming through, I'm losing 10x. And that's where the impact on the business is. And that's the principle of this particular policy from the claims perspective. Okay, next slide, please. And now this is probably the last slide before we get to some of the claim studies, some of the claim scenarios which we have seen in the market, and then we can talk about your questions. Catastrophic cover. This is one reason why I've seen why some of our clients, some of the people who buy trade insurance policy go for it. Because what happens if my top two buyers goes fund or top most buyer goes fund? because that buyer may be having a dependence, my business may be dependence, have a level of 20% or 25% on that individual buyer. We have come across such situations wherein such a heavy dependence is there on an individual buyer. So that's there. Sometimes your financier says that, okay, I'm okay to give you this line of credit, but what is the additional protection you may have? We all talk about collaterals and so many other aspects, but quite often you may not be able to provide all of them. And even if you've provided some bit of it, those things are charged, and then there's a hypothecation which may not be fine with you, with your company, with your board and your stakeholders. So this happens as a tool wherein if you prove that, okay, this is an additional backup of an insurance policy which is there, your financier is happy and he says, fine, I'm going with that. So yes, you can go to the newer markets, you can go to the growth markets wherein you have never ever been to, and that makes an excellent case for you to take that risk that, okay, I was present only in Northern India. Why not explore Western India? Why not Southern India? Why not go to European markets? Why not go to African markets? Why not go to North America? Why not go to South America? So that's how things go about. Now we can move on to the last section of the presentation, which we have been, how I put this presentation section is that when we talk all this, what I've been saying all this like, and more of a monologue, not able to see most of your faces, what always comes up as a good thing in a presentation or thing is that in real life, what have you seen? You may have got your own examples, which I would be happy to look at during Q&A if something comes up. But I'll share some of the examples which we have seen in our market, in our own book and in general. So some of these things is something which I'll be talking in next 2-3 slides. So one thing is the first point which I'm taking up is I'm probably taking you back probably 10 years back into the history in Indian market. We can move on to the next slide. Was about a large claim which has happened in a particular airlines. And that had caused a kind of a setback also to us as an industry, because there were certain regulatory constraints which came in, which are expected to be open up now, and some bit of it was open up earlier as well. So what had happened in that particular case is that we had this airlines, a private airline by the name Paramount Airways. And what happens, this domestic airlines like DGCA gives license and approval. So they said, fine, you need to have minimum these many of aircrafts to run an airline. So fine, they were doing that. And what typically happens is that if you do not comply with those conditions, you cannot fly. That's how any regulated business will work. That regulator has put in terms and conditions, and you have to work accordingly. And how the ripple effect happened in this case is what I will be talking about. So what happened is that they had a license which had a condition that you need to always have a minimum of 5 aircraft to sustain your license. And if 5 aircrafts are not flying at all point in time, then license cannot continue. And what this business airline, what happened is that on 3 of their aircraft, they were not able to make the lease payments. And obviously, because of this issue, they were not able to sustain their licenses. And then there were all kind of supplies. The biggest supply for them is always aviation fuel, which they had credit for a number of months. So they were supposed to pay back to those agencies for the fuel which they have bought. To run the airline and to make the fuel payment, and for other regular businesses, they had taken bank financing. Now, when you've taken a bank financing, then there's another issue that you don't have to just pay your regular creditors. You have to go back to your lender as well and pay lenders due as well. And in those days, it was allowed. Right now, it is not allowed for banks to buy a trade credit insurance, but it was allowed at that point in time. So what it said is that you go, and bank also can take a policy. So in this case, bank had also taken a credit insurance policy. And I'm not aware of whether the aviation fuel companies had a policy in that point in time or not. But what typically happened is that those banks would finance this. I'm talking 10 years back in our market, almost 90 million plus was the line of credit which was out in the market, was all gone. There was no one to pay up. It was a small airlines, domestic only, catering only a few segments, went out of business. And this was the huge sum. 90 million is not a small sum, even today. And if I'm talking 10 years back, for that particular bank, those few banks which have given it, was a direct hit to their balance sheet. And that's where trade credit comes into play. And then when your buyer has defaulted for XYZ reasons, as we have seen why they have, and as a ripple effect, it has come to multiple people, not just to the banks, this policy comes into play. Only thing what happened in this particular case, there were some issues, and this particular case is into litigation at this point in time, because what had happened is that the reinsurance terms with the insurance agreement were not 100% in compliance, and there were gaps because there were multiple policies which had aggregated multiple exposure. So there was an issue out of it because the insurer said that I had agreed for an exposure of say only X, and the exposure we are talking about is much higher. So things could not complete at that point in time. And that is something which gives us another lesson, that when you are buying an insurance policy, again in Indian context, as per the regulation, for one buyer, you cannot buy two policies. For same buyer, you cannot say that I'll take a policy from one insurance company and then I'll go to another insurance company and I say that I want cover again on the same buyer. Because the regulations say clearly, and that's where the essence of this policy comes into play. The cover is about exposure on the buyer. If beyond a level the buyer's creditworthiness is at a question, it cannot be done. However, having said that, there are solutions to it, which I'm sure will sooner or later in the new structure will come in Indian market as well. You can go for an excess of loss cover. You take a base cover from one insurance company, whatever you have taken, and that insurance company is in a position to provide for. And beyond that, you can go for an excess of loss cover. However, having said that, at this point in time, that option is right now not available in our regulatory framework. Now let's move on to another scenario. Okay, before we talk on to this, so I see at the clock as well, I'm keeping my eye there. So it's now 6 o'clock. So I guess I am almost 10 minutes behind the schedule. So I guess I'll take another 5-7 minutes and then we'll open it to Q&A. So in case of 2015, I'm talking some 5 years back, and we have seen in last 5 years or so a lot of shaking grounds in the gems and jewelry industry in our market. I'm sure that we all have seen what has happened in that industry in these 5-6 years. So many defaults, so many bank issues have happened in that industry. So one particular incident which happened in the 2015 particular year is what we saw is, I'm talking of a specific incident, and then the entire industry, how it suffered is, and prior to that, there was nothing wrong. Prior to that, things were working perfectly fine and things worked really, really great shape. But in that particular year, what happened is, obviously it was happening for a little longer duration. There was a particular guy who used to work with a London-based firm. What he did is he got his diamond polished, and he used to get rough diamonds and get them polished and get them ready for his international market sale. And obviously the trade was all on credit terms. And what he did is, in the first few days, he worked on a cash basis. Then he started working on credit basis. And at some point in time, when his exposures crossed close to 100 crores, the guy just disappeared. He simply disappeared. So he created that faith for a few number of cycles and months and duration when his faith was there in the market, and he dealt with number of people. After that, the single incidents, the guy disappeared with close to 100 crores worth of credit line already on him. And the guy who did the job out of Surat, out of Mumbai, were left nothing with them. And eventually, in only in a couple of years, within those 2 years, what we realized, the total issue which happened out of this crossed almost 700 crores worth of rupees. And that's where the impact came into the entire industry in these two markets. And why it happened, and if you look at those things, we have seen that a lot of these monies got put into stock exchange and real estate. And those industries and those markets were also not doing good. So this is where they lost a huge sum of money to the merchants lost this money. Now, what is the lesson? I simply say in the bold, as you see in the slide, which I've written, know your customer. What does know your customer means? Now, typically what happens, it's very easy that someone has dealt with me and I feel that, okay, the exposure which he has taken from me is only 0.5% of my book or whatever. And it's only for large corporations who deal with hundreds of millions of and billions of rupees or dollars worth of turnover that they should get into these so-called bureaucratic processes. Not really. know your customer is the very basic premises. So in today's world, when you're dealing with your customers, yes, trade credit insurance helps you. And that is what trade credit insurance does. It helps you knowing your customer. This know your customer is not about just getting a PAN card or an Aadhaar detail or a auditor certification. It's much beyond that. And that is where this policy comes into play. It lets you really know your customer. Because a buyer may default in any other part of the world. The parent company may default in any other part of the world. And by the time that cascading impact comes to your book in your land, may take a few months. And if you are a SME who may not be taking stock of how the global scenario is changing for the parent company, you may not just realize the impact when it is actually in front of you. And that is where knowing your customer, not just on your own, which is anyways a paramount point, is very important tool which this policy provides us. Let's move on to the another study which we have seen. This is a very particular case. It has happened. I can say that it has happened in front of me. This is my own case, which in I can say that what I've seen over 10 years. JC Penney. Now, JC Penney is a very large name. JC Penney has been a very respected name. It's a century-old departmental store chain, quality stuff, good customer experience, and everything. We have a particular buyer. This insured is my own company is insured, and they have multiple policies depending on the kind of different businesses they have, and almost all of their businesses are with us. But what happened in one particular business of theirs, that and I'm talking to you 10 years back. 10 years back, they took an exposure of 30 crores on this particular buyer, JC Penney. And JC Penney was in bad shape even 10 years back. And given that time, whatever the overall situation, we were in a position, I'm giving an example answer only, say we suggested him that, okay, 30 crores looks too high for JC Penney. We can look at a limit of 10 crores and we can go ahead. My client agreed for some duration. We did the policy, but next year they said 30 crore just doesn't work for us as a business exposure, and you have given me a cover limit only 10 crores. Now my exposure on JC Penney is 45 crores. And we went back to our drawing board, did all due diligence, all kind of complex structuring, and we came back with a long sorry face to our client. And I had to tell my client that, sir, sorry, I am not in a position to give that kind of limit. And at best, I can look at 10 crores, which is there. And because we are entire business with us, so we have been continuously last 10 years talking about this particular thing. But what typically happened is this client of mine, he was having that high-end exposure, and they had to, out of their business compulsions, took this particular buyer out of my policy and placed into another business policy. They took another policy other than my policy. And year after year, we kept on talking, and we never saw JC Penney position getting improved. And we kept on saying, sir, you are building exposure, and even in the other policy which you have taken, you're not covered fully. There are gaps, there are deductibles, and the coverage is also not to the full limit. Why don't you assess it? They somehow felt that, no, we can still take care of it. Come COVID. Now I'm talking a live situation in front of today. JC Penney has filed for bankruptcy. Whether ultimately they will be, because they still have very recently, because we have been tracking this case. So they have been again given, I guess, one more fortnight to come out with a restructuring plan, which looks very difficult to me personally, but obviously that's not for me to comment. The fact remains they have filed for bankruptcy. A company which is good, the company which has got good name, its customers loves it. Fact remains that they have gone for it. And now a buyer on whom we have been tracking for so long, we knew that their situation is not good. We have been giving that pre-warning sign. Someone took advantage, someone didn't. We have all kind of examples. There are people whom we have seen, they do not send a single consignment if that consignment is not within the buyer limits. I'm not saying you do that. That's your call. Insurance policy is only a backup arrangement. Insurance policy can never control your business. But yes, a trade credit insurance can always enhance your business. It can always give you that cushion to go to the newer markets, to go to the higher level of exposure to your existing markets. But that doesn't mean we throw caution to the wind. When something is on our face, which is seen, is being shown, let's do a little bit of extra effort and take advantage of that benefit. So this policy, the beauty, as I would repeat, which I probably would have seen 10 times by now, is not just about claims. Yes, it is about claims, but it is so much about risk management as well, which has to be at the always at the crux of our businesses. So with this, I'll close my thoughts here. See that as better we can manage that cash of ours, which is sitting in someone else's balance sheet and not in our balance sheet till that time. Yeah.
Yeah, Shantanu,
So,
to do question and answers.
yeah, please. So you can read out whichever questions you feel like asking me.
In fact, first we will take the first question itself. Could you please inform the claim amount percent of the insured? Normally,
Okay.
we understand the policy covers an X percentage of the invoice value. So, can you clarify
Right.
that?
Right. So if you ask me in Indian context, because the regulation for the private sector companies talks about 85% indemnity. So that's where it stands at. Of the invoice value, 85% is what is paid. However, having said that, global norm is around 90%. Yes, in some cases, you can negotiate for a 95% as well, which we have seen in our market also in the previous regulatory era. But at this point in time, this is capped at 85% out of regulations.
Then second question is the extension period of 60 days a max? Because
Okay,
normally we come across DA 90 and sometimes 120 as well.
Right. This was just an example in this slide. Whatever you saw as a number is purely an example. These days, these timelines are always structured and customized as per your business requirement. So if I'm talking about agro business in Indian context, or even in a lot of international markets also, if you look at, we'll have 2 cycles. You'll always see that there are 2 crops. We call Rabi crop, we call Kharif crop, and generally we say a 180 days cycle. So there, the industries which are dependent on that, farm equipments, pesticides, chemicals, fertilizers, they will always go for a 180 days credit cycle. So generally what happens, the credit cycle is what your business decides, and maximum extension period can be then negotiated with the insurance company basis your business requirement and the comfort of that particular policy. But yes, it can be. It is open.
Yeah, then the third question, in fact, just I will put it in this way. See, our regulatory asks us to have minimum 10 buyers. And then normally business enterprise with a turnover of 300, 400 crores. Normally we'll have 3-4 buyers doing, in fact, almost 70-75% of buying for them. And 25% used to be for remaining buyers. Then when we put a proposal to an underwriter, the underwriter used to reply to us that accumulation of sale on lesser number of buyer is more. So they reject the proposal. So in a net basis, the proposal never gets in fact converted to an insurance policy. This is the in fact one point. The third question, which in fact I would like you to emphasize upon, like how do we need to take up a proposal form with the insurance company?
Okay, so accumulation of buyers. I would say accumulation of buyers is a 2-pronged approach. One is how much that particular insurance company's appetite is, one, and second, how much of the dependence of that particular business is. So the first part of answer which I heard from you is answer the example you gave, the insurance company gave, would be more about their appetite also in that particular buyer. Because I'm talking of, say, in Indian context, let's talk of the names which we are aware of. So I'm talking, say, Coca-Cola, which is an international name. I'm talking of Tata Group. I'm a Tata Group company. I'm talking Birla Group company. I'm talking Bajaj Group company. Now, these are the household names, correct? I'm talking Reliance. These are the names, household names, giants. We know about them. Now, if a particular business has got a great dependency on that particular buyer, it can still get a business out of it. It can still get an insurance policy out of it. But I'm dealing with a company, I'm dealing with a buyer who's not a large name, who's a small time name, but now my entire exposure is on that particular buyer. And 50% of my sales are going on that particular buyer. Then until and unless that particular buyer has got a great level of comfort, which can come out of his standing, then yes, insurance company can give it. But that is where the beauty that is where the difficulty, that's where I was calling it two-pronged, comes into play. So it is a function of what kind of buyer set I am talking about, not just the exposure I have. That is one parameter. What kind of buyer? So if it is a listed company on which a lot of information on public domain is available, may be slightly better than a partnership or a proprietorship company wherein information may not be available in the public domains, and information being not available may not be so easy to assess their credit worthiness. So that's where it comes. And another option what you can do is that you can go for a lower indemnity. Then probably you can ask insurance company, fine, if you do not have comfort on this basis, instead of 85%, can we work on a 70% indemnity basis if it suits your business? And that is how things can be structured.
Yeah.
But yes, the answer would be yes and no both.
That is what, in fact, see, accumulation in our normal day-to-day things also, if you look at 80% of production is being done by 20% people, and remaining 20% is done by 80%. So
Correct.
why don't underwriters also go and do and underwrite those particular proposals where in fact accumulation is higher?
Right, I would say that that's what my answer is, that as I said, yes and no. That yes,
okay,
it can be done, sometimes it can't be done.
Okay, then I'll move on to another question. In fact, it's very interesting. Can insured have a two insurance policy?
No, the regulations do not allow. And why would you need two policies? Basically to cover your buyer exposure beyond what one insurance company is giving, right? That is the only scenario wherein a business will require. So I need a cover of 100, and the insurance company with which I have a policy is saying that, okay, I can give you a cover only up to 60. I cannot give beyond 60. So the balance 40, which you need, is not being provided for. And that is why you are talking of a second insurance policy. Now, if you ask me, in international market, we call these kind of options as excess of loss and related covers, which is generally not a norm in our market as at this point in time because of the regulatory constraints, and to an extent of level market has developed or yet to be developed. But those solutions are there. But yes, to be honest, at this point in time, we do not have a proper solution in our market owing to the regulatory constraints.
Okay. Next is a very interesting question. Can we cover a financial institution?
Okay. Covering a financial institution, a bank or a factoring company or a bill discounting and all these factors. In fact, that's the example which I took in one of my case studies when I was talking about, was a trigger wherein the reinsurance arrangements had those gaps, and a regulator took a step that in Indian context, you cannot cover them. So a bank cannot take those kind of policies, or a factoring company cannot take those policies. Though in international market, if I say a factoring business survives on the back strength of a trade credit insurance itself, which is not there in our market. So it's not there. Having said that, very recently, our regulator, just only a few months back, regulator has put in a working committee in place to come out with suggestions that for the development of this particular market, because it is something which is core for the economy as well. It's not just about a basic structuring for an individual policy holder as such. It's a policy which impacts the entire export segment. So for the entire economy's development, how we should look at it, and they are talking on this front. So I'm quite hopeful, keeping my finger crossed, quite hopeful this time that we should get some of these solutions coming out.
Okay. Then question on rejection of cargo, in fact, and then related to the payments. Can you put a little light on this?
Okay.
Or maybe a buyer reject, in fact, buyer doesn't accept the consignment. What should be the, yeah.
Okay. Now, buyer doesn't accept the consignment, which means the sales is not complete. That is the theory answer I would give. So my theoretical answer is, as I was talking entire through my presentation, that evidence of debt will only work when you can prove that there is an account which is receivable. An account is receivable only upon the sale is complete. If the sale is not complete, there is no account receivable because something has not been done. In this particular case, buyer has refused to collect the goods. He's not taking it for XYZ reason. And obviously we are talking the reasons wherein it is wrong. In domestic scenario, it may not be a very big hit for a seller because he can always get his goods back. Yes, it will come at a cost, but generally those costs are bearable cost. But in case of an export consignment, it is a huge cost. getting it back may not be just a feasible solution, and he may have to salvage it by selling it at XYZ market at a very, very discounted price. So again, with a way of status we have in our market at this point in time, I don't like answering it the same way every time, but probably all these questions have given me a situation to say regulatory reasons. So in international markets, this is something what we call contract frustration, wherein the buyer just does not take it. He has frustrated that particular contract and not taking the delivery. Is a cover wherein coverage is offered by the insurance policy. It talks of that situation. In fact, not just, it goes beyond. Even in case of those scenarios wherein you have started your production, I'm going a step beyond. You are under work, your work is under process on a project-based work which you are doing. And on a project-based work, what happens, you may not be doing multiple things and your exposure on that particular project may be very high. So you're doing that, and in between your buyer says that I cannot go ahead with that, and you have spent a lot of money into it, you're stuck. So these kind of things comes under such scenarios and are taken care of. But again, right now our regulation strictly says that the sale has to be completed, and then only we'll get into this scenario. So we'll have to probably wait out for such advanced and evolved covers to come to our market.
Yeah, in fact,
Time
next
for
question.
two more questions, Nikhil, and then we could close it.
Yeah, see this question. In fact, I am just this is a little bit a tricky question asked by someone. Can this insurance work as a surety bond for submission with a financial institution?
Nikhil, sorry, your voice garbled at my end at least for some reason. Can you just repeat that question, please?
Can this be used as a surety bond in place of receivable for submission with a banker?
Okay, so that goes back to the original question when we talked about when the cover can be taken by financial institutions or not. So surety bonds is again a demand of the market, but again in our market it has not been allowed. However, very recently, again there is one development which has happened only for the real estate segment, I would say, in terms of bonds. So wherein government is saying that there are so many real estate projects and road projects, especially they came out of road projects, wherein they said that road projects take longer to come up. So can we ask those contractors to be given a surety cover by the insurance policies? So that comes as a financial backing, as a guaranteed bond. Surety bond is nothing but a guarantee that I'll compensate if this performance is not complete basis the financial strength and other parameters. So that is another thing which is not there right now, but very recently I have seen that that demand having come up, and you never know if it comes up. That will be really, really great for the industry.
Thank you, Shantanu. In fact, one last question. Is there any synergy between insurance company and financial institute where FIs have lent to exporter and these exporters have trade credit insurance? Have the assignment of insurance comes into play? I think this is something similar which I have asked you.
Correct. But yes, sales, one thing is which is there a little off out of it, but that came to my mind from the assignment point, which is an important point. Whenever someone has a financial interest in a policy, he always wants the policies to be assigned. So a loss paying name can be done. The proceeds of the claim can be assigned to anybody instead of just the policy holder. But the policy itself cannot be assigned at this point in time. So I went a little off because the previous question is exactly taken care of, but this is where the assignment status is.
Okay.
Thanks so much, Nikhil. Thank you,
Yeah.
Shantanu. There are quite a few unanswered queries. So what I would request participants is whose questions have not been taken up, please leave your mail, email, or contact details on chat. We'll certainly get back to you either by phone or mail and help you clarify on those queries. So now I'll just request my colleague Kaushal to deliver a vote of thanks and get this session to an end.
Thank you, Shantanu. Good evening,
Thanks,
all.
thanks a lot.
Yeah. Has all good things come to an end? So does this webinar. On behalf of Way2Wealth, I take this opportunity to propose a vote of thanks to our speaker, Mr. Shantanu Pathak. We are sure his thoughts on topics like the need for insurance credit, current market trends, policy, and case studies which we have foresighted on would provide certain information to our esteemed participants. I also thank our participants for their valuable time to hear us out. Thank you, Raheja QBE team and our team at Way2Health to help us conduct this event. We also thank our partner, Mrs. Blossom Advisors, Mr. Rajesh Khebani, and who have been actively supporting us for the conduct of this webinar. Blossom Advisors and Consultants Private Limited is a 5-year young boutique debt syndication firm which focuses on supply chain finance and structured trade finance. It is run by professionals with deep roots of and strong branches. Our next webinar, as part of our ongoing webinar series on the BFSI segment, is on life insurance application in business. It is scheduled on 23rd September, Wednesday, from 5 p.m. to 6 p.m. The speaker is Mr. Prashant GS, who is an Associate Vice President at ICICI Prudential Life Insurance Company Limited. We shall be shortly mailing you the YouTube link of today's webinar, along with a survey form for your valuable comments. I thank you all once again. Over to you, Mr. Shantanu Bharadwaj.
To all participants, Shantanu, once again, very well delivered and informative presentation. And wish you a good evening.